In less than 48 hours, gold did something that textbooks insist is rare. It snapped from above $5,587 an ounce down near $4,403, then surged back over $5,000 as if the drop had never happened. Not months, not weeks, in 2 trading days. And the most important part is not the drama on the screen. It's the message hidden inside the mechanics. The market is stressed. They told you this kind of move could never happen without a world-ending shock. Yet it happened in full view on ordinary trading platforms, while most people were still watching the same old narratives: inflation, rate cuts, geopolitics, elections. Those stories matter, but they weren't the trigger. The trigger was a sudden flip in global risk behavior, and the response was immediate. The kind of response that reveals who is forced to act and who can wait. Here's the uncomfortable truth. By the time price looks obvious, institutions are already adjusting exposures. They don't need to predict the future. They manage what can break. They watch liquidity, margin, and the plumbing of derivatives because that's where the first cracks appear. Retail sees the headline. Institutions see the stress test. And when the stress test fails, the reaction is fast, cold, and mechanical. What I'm about to lay out is not a theory. It's a pattern. A sequence that has repeated across decades whenever the world transitions from normal markets to regime change. The details change. The instruments change. The actors rotate. But the playbook stays eerily consistent. Welcome to Channel Name, where we decode what matters before it becomes the story everyone repeats. We track the numbers and the footprints, margin changes, contract flows, reserve shifts, and cross-asset signals, so the structure shows up clearly. If that's your kind of clarity, stay with me like you'd listen to the one calm voice in a noisy room. And while you listen, comment where you're watching from, because the market is global and the perspective matters. Now let's reconstruct what actually happened, because the timeline matters. On February 12th, 2026, risk appetite cracked across markets, 6%, and the Nasdaq dropped about 2% in a single session. 11%, one of its lowest prints of the year. That combination, stocks down, yields down, is a classic risk-off signature. Normally, gold loves that environment. Gold tends to behave like a calm mirror. When fear rises, it reflects the demand for protection, usually with a steady bid. But this time, gold didn't just rise, it snapped. First, it plunged. Then, it rebounded. And that whipsaw tells you the market wasn't simply rotating into gold as a haven. Something else was happening underneath. A violent deleveraging event followed by reaccumulation. To see why, you have to think about how modern precious metals trading actually works. The global gold price, most people quote, is not a stack of bars changing hands. It's a number discovered in futures markets where traders use contracts to control a lot of exposure with relatively little capital. That leverage is not inherently bad. It's what makes markets liquid. But it has a consequence. When volatility spikes, the exchange raises the cost of carrying positions through margin requirements. And when the cost of carrying positions rises, the market becomes less about opinion and more about arithmetic. This is where it gets interesting. Around the same period as the price shock, exchange margin requirements were tightened. For example, gold margin requirements for certain profiles were lifted from 8% to 9%. And silver margin requirements jumped from 15% to 18%. Those numbers might sound small, but in leveraged futures, a 1% change is a sledgehammer. It forces the weakest hands to either post more collateral or reduce exposure. And in a fast market, reduce exposure doesn't mean a careful decision. It means a forced sale. That's the central mystery. Why would margins rise and volatility spike at the same moment gold is supposed to be acting as a refuge? The answer is that gold was caught between two worlds. One world is the strategic world, central banks, sovereign reserves, long horizon institutions, where accumulation is slow and deliberate. The other world is the tactical world, derivatives, funds, and traders, where positions are managed minute by minute and liquidated without emotion. In the tactical world, gold can be sold for the same reason anything is sold: to meet margin calls somewhere else. When equities drop and volatility rises, multi-asset portfolios often have to rebalance. If something is up, it becomes a source of liquidity. If something is liquid, it becomes collateral, and gold futures are among the most liquid instruments on Earth. So paradoxically, in the first wave of stress, gold can be sold not because confidence in gold disappears, but because cash is needed immediately. Then the second wave arrives. After forced selling clears, the strategic buyers step in. The same institutions that were never over-leveraged in the first place see a discounted price and treat it as a window to rebuild exposure. That's how you get the whipsaw. Liquidation first, then re-anchoring. Two different participants, two different objectives, one price chart. If you've seen this movie before, you know the plot. In 1980, gold surged into a blow-off top during a period of inflation fear and geopolitical tension. The move was extreme, and the aftermath was brutal as tightening financial conditions and changing expectations crushed the froth. In 1998, during the long-term capital management crisis, liquidity vanished across markets, spreads blew out, and anything that could be sold was sold, even quality assets, because the system needed cash. In 2008, gold initially sold off with equities because everything was sold to raise dollars. Then it began a multi-year climb as central banks responded with aggressive liquidity and policy shifts. In 2020, the same two-step appeared again. Sudden liquidation first, then a powerful recovery once the funding panic faded. Different years, same structure, stress hits the system, leverage gets unwound, and then the longer-term narrative reasserts itself as policy responses and reserve behavior evolve. What changes is which part of the sequence you're watching. If you look at the full arc, you see it behaving exactly like a stress barometer in a leveraged world. Now, layer in what makes 2026 distinct, the reserve story. 19 million ounces. That kind of steady buying is not a trade. It's a policy choice about what counts as resilient collateral in an uncertain world. And when policy demand is on one side and leveraged liquidation is on the other, the price can gap violently in both directions. Here's where expert contradictions become useful. Some prominent hedge fund voices have argued that gold is increasingly acting like a replacement for U.S. Treasuries and reserve portfolios, pointing to massive central bank purchases in the prior year, hundreds of metric tons. At the same time, conventional narratives insist Treasuries remain the ultimate safe asset, and gold is merely a fear trade that fades when rates rise. Those statements can both sound reasonable, yet they point in opposite directions. When narratives collide like that, the market often resolves the argument not with commentary, but with price behavior that exposes the underlying constraints. The market's recent behavior suggests something more nuanced. Gold is becoming a strategic reserve asset for some institutions, while still being treated as a tactical liquidity tool in derivatives markets. That dual identity is exactly what produces dislocations. And dislocation is the key word here, because dislocation is not opinion. Dislocation is when two parts of the same system tell different stories at the same time. One of the clearest dislocations in this episode was cross-asset behavior. Equities were down hard, yields were falling, and yet metals were behaving like they were being shaken by funding stress. That's the tell. When the supposed hedges behave erratically, it usually means the hedgers are under pressure elsewhere. It's not that the hedge is broken, it's that the hedge is being used as a cash machine. Let's talk about evidence, not impressions. One way to measure stress in the gold market is to look at futures activity and open interest. On February 12th, trading volume in COMEX gold futures was reported around 178,099 contracts, with open interest near 403,117 contracts, rising by roughly 3,674. Volume that large tells you a lot of risk was being transferred. Rising open interest during turbulence suggests not just positions being closed, but new positions being established. That supports the idea of a handoff, weaker hands forced out, stronger hands stepping in. Silver, meanwhile, often behaves like gold's amplifying mirror. Silver's drop was severe, with reports of it falling from around 121 to near 64 at the lows, alongside outsized one-day percentage declines. Silver also faced the larger margin jump from 15% to 18%. When silver moves like that, it's rarely about jewelry demand or next quarter's industrial forecast. It's about leverage and liquidity. Silver is the market's pressure gauge for speculative excess. When it collapses quickly, it often signals that financing conditions tightened abruptly, and the market is clearing positions at any available bid. Now, zoom in on the institutional plumbing. Futures are cleared through central clearinghouses. Those clearinghouses set performance bond requirements and monitor risk in near real time. Brokers then add their own house margins on top of exchange minimums, especially when volatility rises. Funds using leverage may face intraday calls. And here's the part most people miss. The call doesn't care about your thesis. If you can't post collateral fast enough, the position is reduced for you. That's the mechanism that turns a sell-off into a cascade. This is why exchange margin changes matter so much. They can be framed as risk management, and they are. But they also change the behavior of the entire ecosystem in the moment. When margins rise, leverage capacity falls. When leverage capacity falls, positions that were fine yesterday become too large today. And because many strategies are systematic, the selling pressure can become synchronized. It's not a conspiracy, it's alignment. Everyone is responding to the same constraints at the same time. To understand why a single percentage point matters, look at the math the professionals can't ignore. A standard gold futures contract controls 100 troy ounces. When gold is near $5,000, that is about $500,000 of notional exposure in one contract. If the required performance bond is 8%, the trader ties up about $40,000. If it rises to 9%, the same position suddenly demands about $45,000. That extra $5,000 per contract doesn't sound dramatic until you scale it across an entire book. No debate here. Scale is everything in futures. A desk holding 200 contracts is controlling roughly $100 million of notional exposure. A 1-point margin change turns into about $1 million of additional collateral that has to appear fast, usually in cash or cash equivalents. That is why traders don't debate margin. They respond to it. Silver is even more sensitive because it's thinner and naturally more volatile. A common silver futures contract controls 5,000 ounces. At $80 an ounce, that's $400,000 of notional exposure. A move in required margin from 15% to 18% lifts the collateral burden from about $60,000 to about $72,000 per contract. That's $12,000 more per contract. Multiply that by 500 contracts, and you're staring at $6 million of extra collateral demanded. Immediately, right when the screen is flashing red. This is why the timing can look coordinated even when it isn't. Clearinghouses react to realized volatility. Brokers react to clearinghouses. Funds react to brokers. Algorithms react to price levels and volatility filters. Everyone is responding to the same constraint, so the output becomes synchronized. And when liquidity thins, a relatively small wave of urgent selling can produce a very large move. That's not a statement about value. It's a statement about microstructure. Now think about what happens on the rebound. The forced seller is done only when leverage is reduced and the margin call is satisfied. The buyer with cash is free to act whenever the price is attractive. That is why rebounds can feel impossible. The sellers were not expressing a long-term view. They were meeting a requirement. The buyers are not reacting to a headline. They are executing a plan. There's another quiet clue in episodes like this. Watch where activity concentrates. When stress hits, action often explodes in the most standardized instruments, front-month futures, highly liquid options, and the biggest benchmark ETFs, because those are the easiest places to raise cash and hedge quickly. Physical demand doesn't vanish, but it rarely sets the headline price in the first minutes. Over days, the balance can shift. If the sell-off was mainly leverage, price usually stabilizes once margin pressure stops and bid-ask spreads normalize. Then the market starts responding again to slower signals like reserve accumulation and real rates. That transition is the tell professionals watch. When that happens, volatility falls and the narrative suddenly catches up. So what does it mean when global markets flip and gold reacts instantly with a violent two-step? It means the market is repricing not just risk, but the cost of holding risk. That's a subtle but crucial distinction. Risk can be priced through valuations and stories. The cost of holding risk is priced through funding, margins, and collateral rules. When that cost spikes, everything changes because the market's capacity to carry exposure shrinks. This is the part no one is discussing with enough clarity. Margin policy is not a footnote. It is a lever. When exchanges raise margin, they are effectively reducing leverage across the system. That can cool bubbles, but it can also accelerate crashes by forcing sales into thin liquidity. It's like tightening the seatbelt after the car has already started to skid. Necessary, but painful, and it can bruise you even if it saves you. Now, let's connect the players in this episode. You have exchanges like CME overseeing key futures contracts. You have clearing members and brokers enforcing collateral rules. You have macro funds that run multi-asset books, where gold is one line item among rates, equities, credit, and FX. You have risk parity strategies that adjust exposure based on volatility. You have commodity trading advisors and trend followers who flip when price breaks specific levels. And you have sovereign and central bank actors whose time horizons are measured in years, not minutes. When a large sell-off hits equities, those automatic strategies often sell what they can, not what they want. They sell liquid assets. They sell futures. They sell exposures that can be reduced quickly. That is why gold, despite its safe haven identity, can become a source of cash in the first shockwave. Then, when the dust settles, the strategic accumulation story returns, and gold reclaims ground. But here's the deeper dislocation. Paper price versus physical reality. Futures markets can create enormous paper supply through contracts. Physical supply is constrained by mining, refining, shipping, and vault logistics. When leverage unwinds, paper price can fall far faster than physical fundamentals change. Meanwhile, strategic buyers who care about the asset itself, not the short-term mark-to-market, see that drop as a window. This gap can show up in subtle ways. Sometimes it's regional differences between trading hubs. Sometimes it's persistent premiums for certain bar sizes. Sometimes it's central bank purchases that continue quietly even while price swings violently. You don't need a secret story to explain it. You only need two different participant types operating with two different incentives and time horizons linked by a single benchmark price. Here's a simple analogy that captures the mechanism. Imagine a stadium where most people are holding tickets they borrowed money to buy. If the lender suddenly demands more collateral for those tickets, a lot of people have to sell immediately. Not because they don't want the event, but because they can't finance the ticket anymore. The ticket price falls quickly because sellers overwhelm buyers in the moment. Then, once the forced sellers are gone, the people who bought tickets with cash and actually wanted to attend scoop up what's available. The price snaps back, not because reality changed, but because financing changed. That's what margin does. It changes financing, and financing changes price. Now, add the global dimension. Gold does not trade in one place. It trades across futures exchanges, over-the-counter markets, and physical centers, with London historically central to spot dealing and Asian hubs, increasingly influential in demand. That creates a natural tension between paper liquidity and physical accumulation. When Western derivatives markets are under pressure, the price can be driven by liquidation. When physical demand is steady elsewhere, it can pull price back once the liquidation wave finishes. That tug of war can look chaotic, but it's simply different clocks ticking at different speeds. So what should we watch next, purely as analysis of the pattern? First, watch the relationship between risk assets and yields. If equities continue to weaken while yields fall, it suggests risk aversion is intensifying and growth expectations are softening. Historically, that environment tends to support gold after the initial liquidation phase, particularly if the dollar's funding stress eases. Second, watch margin and collateral conditions. If exchanges continue to tighten margins, or if brokers raise house margins, that tells you the system is still shrinking leverage capacity. Third, watch participation. Rising open interest during turbulence can be constructive if it reflects stronger hands stepping in, but it can also be dangerous if it reflects new leverage layering on too soon. The difference often shows up in how quickly dips are bought and whether price can hold key levels after rebounds. Fourth, watch silver. Silver often leads in both directions. If silver stabilizes and stops acting like a margin call barometer, it can signal the worst of the forced liquidation has passed, and the market's plumbing is regaining balance. And then there are the broad scenarios, framed the only honest way, as conditionals. If the risk-off regime persists and official accumulation continues, historically, gold tends to transition from a volatile trade into a higher floor asset, where dips are absorbed more quickly and the market begins to price a new range. If risk stabilizes and real yields rise, gold can consolidate and drift, allowing speculative froth to cool and positioning to normalize. And if policy shocks or liquidity events escalate, gold can experience more two-step moves, sell-offs, driven by liquidity needs, followed by sharp recoveries as strategic demand reasserts itself. Notice what I didn't do. I didn't promise a number. I didn't claim certainty. Because the market is not a single story, it's a system. And in systems, the same inputs can produce different outcomes depending on constraints. The constraint right now is leverage capacity. When that capacity shrinks, markets become jumpier. When it expands, markets become smoother. The price chart is the output, the constraint is the input. The divide ahead is simple. There are people who watch price alone and feel whiplash, up, down, confusion, emotion. And there are people who watch the plumbing, margin, liquidity, cross-asset correlations, and reserve behavior. Those people don't need to feel certain. They just need to see the structure. It's not about being smarter. It's about paying attention to the right layer. Information gaps become wealth gaps because institutions operate on a different layer of information. They move first because their dashboards are different. Retail moves last because retail is fed narratives after the fact. But the market always leaves footprints. The price move is the smoke. The plumbing is the heat. So when you hear global markets just flipped, don't treat it as drama. Treat it as a diagnostic. A flip tells you correlations are changing, funding is tightening, and stress is moving through the system. Gold's instant reaction, down hard, then up hard, tells you both sides are active, forced sellers and patient buyers. That is not chaos. That is a transfer.